Gold isn't topping. It's being forced through a mechanical reset, and the loudest voices calling it a healthy liquidation are the same incentives that can afford a disorderly move when the plumbing starts screaming. This isn't about vibes. It's about collateral leverage and a very specific 18 billion sized fingerprint that just showed up in public data if you know where to look. And before we're done, you'll have three things most people never get: the hidden detail that reframes the entire story, the calendar trigger that makes the next 1 to 2 weeks dangerous and opportunity rich at the same time, and the exact levels and signals that tell you whether this is a controlled retest or the start of a squeeze that can gap without asking permission. Right now, the most important thing to understand is that gold can be both bullish and violent in the same breath. Those two are not opposites. In this kind of regime, volatility isn't a side effect. Volatility is the tool. And if you've been around metals long enough, you've seen the pattern. Price runs, headlines get euphoric, then suddenly a wave of responsible risk talk hits your feed. Lock in gains, reduce exposure. It's overextended. And on the surface, that sounds prudent. But the timing is always suspiciously aligned with one thing: the moment the market structure becomes fragile for the people warehousing risk. When I say bullion banks panic, don't picture cartoon villains. Picture risk desks. Picture value at risk limits getting clipped after a huge year. Picture liquidity thinning in the first weeks of January when books are being reloaded, mandates are being reset, and everyone wants to look disciplined at the start of a new year. The pressure isn't emotional, it's operational. Because if you're a dealer, you're not just watching price. You're watching how many clients are leveraged, how tight the funding market is for metal, how much collateral is being demanded, and whether the next downdraft turns into forced selling that spills into your book. Here's the screen reality. Gold has been moving in big, clean chunks, and the whip is the point. Early January prints have been hovering in the low to mid 4300s and pushing into the 4400s, with spikes that remind you how quickly it can run when liquidity thins. That's not random. That's a market where every marginal buyer matters, and where the wrong positioning on the wrong day can turn a minor dip into a cascade. And that's where the real pressure starts. Now, the title says they called every client to liquidate. You don't need a recorded phone call to understand the behavior. In any market that just posted a monster year, the industry reflex is the same: cut leverage, reduce gamma exposure, tighten terms, and nudge clients toward being smaller. Sometimes that's a public narrative. Sometimes it's a quiet tightening of margin, credit, or risk limits. Sometimes it's a broker telling a client, you don't have to sell, but if you don't post more collateral, the system will sell for you. That line isn't a conspiracy. That's the standard operating procedure of leveraged markets. And now we hit the underappreciated piece that most people missed because it doesn't show up as a sexy chart. It showed up in macro data. The U.S. trade deficit in October 2025 dropped by about $8 billion from the prior month. That's a massive swing. People argued about tariffs, about imports, about politics. But the more interesting reality was simpler. A surge in precious metals exports helped distort the headline. In other words, gold moved in size across borders, enough to visibly move a national statistic. And that's the hidden detail you need to sit with, because it changes the power dynamics. If metal is moving physically in size, the paper price is no longer the leader. The paper price becomes the follower. That's not a slogan. That's how arbitrage and balance sheets work. Physical moves create funding needs. Funding needs create hedging needs. Hedging needs show up in futures and options. Futures and options flows change the path of spot. And then the headlines arrive late, pretending the chart was the cause. But that's not the part that matters. Think about what it means when gold S relocation is large enough to show up in trade flows. That implies inventory decisions, vault decisions, financing decisions, and cross-border routing decisions. Some of that is driven by tariffs and timing. Some of it is driven by where liquidity is cheapest, where collateral is most useful, or where delivery obligations are easiest to meet. And a lot of it is driven by one core reality. In a stress window, people don't want the idea of gold. They want gold where it counts. If you want to understand why a bullion bank would want clients to de-risk, you have to understand the chain reaction of leveraged exposure in a market like this. Here's the brutal mechanic, in plain English. When you hold a leveraged position, you don't just have a directional bet. You have a collateral agreement. If price moves against you, the system demands a variation margin. That demand is time-based. It doesn't care what you think will happen next week. It cares what you can post today. And if you can't, the system liquidates. That liquidation creates more downside, which triggers more margin calls, which creates more liquidation. That's how a dip becomes a flush. It's not because the world suddenly hates gold. It's because the market forces weak hands to sell at the worst moment. Now add options, and the whole thing becomes more reflexive. Dealers hedge. That's their job. When there's a lot of open interest around popular strikes, dealer hedging can push the market. Here's the clean version. If the market is positioned such that dealers are short options, they often have to buy as price rises and sell as price falls to stay hedged. That turns normal movement into feedback. Up moves force buying, down moves force selling. And when the market is hovering near big strikes, a small move can flip the sign of those flows. That's why you sometimes see price behave like it has a magnet, then suddenly behave like the magnet snapped. And if this one level breaks, the math changes. So what are the proof points that this is structural pressure, not just a story someone told to farm clicks? Proof point 1 is the shape of the move itself. In a healthy, sleepy market, gold grinds. In a stressed, flow-driven market, gold jumps, snaps, retests, and runs again. You get fast pushes into resistance, then sharp rejections that look like the top. To anyone who doesn't understand positioning, those rejections are often liquidity hunts. They're designed by the market structure, not by a mastermind. Stops cluster at obvious spots. That's human behavior, and markets monetize human behavior. Proof point 2 is participation. In metals, the fight shows up in futures activity and open interest. When participation builds, it means risk is being warehoused somewhere. Someone is adding exposure, someone is hedging exposure, and someone is writing protection. That's not retail. That's an ecosystem of institutions expressing risk in different ways. And the more crowded the structure becomes, the more violent the unwind can be in either direction. That's the paradox. Rising participation can be bullish longer term, but it is also the fuel for sharp liquidations because there is more leverage in the system. Proof point 3 is the physical backdrop. London Vault holdings at the end of December 2025 were reported around 9,106 tons, a month-over-month increase of a bit over 2%. That's not a meme, that's metal sitting in the most important wholesale hub on Earth. And when vault totals rise into year-end, you should hear the signal: positioning, collateral, settlement, preparation. It doesn't tell you up tomorrow. It tells you the physical layer is active. And that matters because the physical layer is what ultimately constrains paper when stress rises. But that's not the part that matters yet. Proof point 4 is flow behavior in the investment wrappers that matter. Physically backed gold ETFs saw exceptionally strong inflows through 2025, with multiple reports describing record demand and record assets under management. Again, you don't need to worship ETFs to respect the signal. When big pools of capital use a wrapper to accumulate exposure, that changes the marginal buyer. It changes volatility. It changes how dips get bought. It also changes how dealers manage inventory and hedges around those flows. Flow isn't a narrative. Flow is a force. Proof point 5 is the macro regime that made gold behave like a reserve asset, not just a commodity. Over the last year, the conversation around debt, geopolitical stress, and currency confidence didn't stay theoretical. It became allocation. When large institutions and official sector buyers treat gold as insurance, they don't chase perfect entries. They accumulate, they rebalance, they respond to calendar, they buy weakness and ignore noise. That's what makes corrections dangerous for leverage traders and irrelevant for allocators. And that difference in time horizon is exactly where banks get nervous, because banks sit in the middle. Proof point 6 is the supply response. And here's where you need to be intellectually honest. Mining supply has been improving. There are forecasts that mined production was on track to reach record levels in 2025. That S real. And it's the kind of counterpoint skeptics love. More supply is coming, so the price should fall. But supply response in gold is slow and blunt compared to financial flows. A mine ramp isn't a day trade. Refining and logistics aren't instant. And even when output rises, the price in a given week is often dominated by what the paper market is forcing participants to do. This is why you can have more supply and still get upside squeezes, because the short run is structure, the long run is fundamentals, and you're trading the calendar, not the textbook. Now, let's make the 18B detail concrete without turning it into mythology. The U.S. trade deficit swing of roughly $18. $8 billion was a headline shock, and analyses pointed to gold and precious metals exports as a significant driver. That aligns with a pattern that's become more common. Gold moves into the U.S. when there are incentives or fears around tariffs, settlement, or financing, and then it moves back out when conditions change. Switzerland often appears in that chain because it's a critical refining and distribution hub. That doesn't mean someone dumped. It means the system rerouted metal for economic reasons. But if the system is rerouting metal, it's also rerouting hedges, collateral, and risk. And that's where the market gets sensitive. Here's the key mental model. When the physical layer is moving and the paper layer is crowded, you can get a situation where the price you see is less about fair value and more about how quickly risk needs to be transferred. In that world, the people who want to call market don't try to prove gold is overvalued. They try to create two-way trade. They try to scare late buyers. They try to shake out levered longs. They try to convince you the move is done so they can stabilize their books. That's not evil, that's incentive. So why now? What's the calendar trigger that turns this from a general thesis into a right now setup? First, year turn and early January liquidity is a real phenomenon. The market is rebooting, new allocations are being implemented, old hedges are being reloaded, some desks are thinner, some mandates restart. That creates pockets where price can move more on less volume. In those pockets, stop runs are easier and gaps are more common. Second, U3 moving toward the first meaningful checkpoints of the new year, month-end positioning, and the next major options in futures rhythms. In metals, delivery windows and contract cycles matter because they force real decisions about whether exposure stays paper or becomes something that has to settle. You don't need to trade delivery to respect that delivery exists. Third, macro data releases and policy expectations are catalysts because they can shift real rates and the dollar quickly. Gold is sensitive to those inputs even when it's acting like a reserve asset. If the market suddenly prices fewer cuts, or if risk sentiment snaps, you can get a sharp downdraft. That downdraft isn't necessarily bearish for the year, but it can absolutely be bearish for the next 48 hours. And that is exactly how strong trends punish weak risk management. Now I'm going to say something that separates pros from addicts. The thesis can be right and you can still get smoked. Gold can whip around violently even if the bigger trend is intact. That's not a warning label to scare you out of the trade. It's the reality that keeps you from handing your position to someone else at the worst time. Trend signal and noise are not the same. Trend signal is about structure. Higher highs, higher lows, persistent demand on dips, and steady flows that don't reverse at the first headline. Noise is everything else. Intraday spikes, emotional commentary, and one-day explanations. The market will weaponize noise to separate you from your plan. And the next detail is what flips the whole setup, the psychology layer. Here's the viewer psychology shield, and you need it because the market will absolutely try to manipulate you with the sensation of speed. When price drops fast, your body reacts like you're in danger. Your brain wants to resolve uncertainty by doing something. Selling feels like relief. That's how you get trained into buying high and selling low without ever realizing it. The pros don't remove emotion, they design around it. They pre-commit to what matters, and they treat everything else as theater. So how do you design around it? You don't need complex math. You need a checklist and a two-scenario lens. You also need a level that invalidates your thesis, because without invalidation, you don't have a thesis. You have a hope? Let's do the two scenarios in a way that's actually useful for the next 1 to 2 weeks. Scenario 1 is the controlled pullback and retest. In this scenario, the market cools. It retests. It shakes out leverage. You see price dip into a support band and then stabilize. The signal isn't one green candle. The signal is behavior. The dip gets bought, and importantly, it stops accelerating lower. You often see that as failed breakdowns, wicks, and quick recoveries. If gold holds above the psychological $4,300 zone, it can reclaim the mid-$4,400s with authority. That's the market saying, we are absorbing supply. In that world, the pullback was a reset, not a reversal. And that's where the real pressure starts, because once weak leverage is flushed, the path for continuation becomes cleaner. Scenario 2 is the continuation squeeze and gap risk. In this scenario, gold doesn't give you a polite entry. It launches through resistance and doesn't look back. This tends to happen when positioning is wrong-footed or when options hedging flips into forced buying. You see the market take out a recent high, keep going, and then refuse to dip. That's the signature of a squeeze. Every small pullback gets bought because shorts are covering and dealers are hedging. The risk in this scenario is not that you miss a perfect entry. The risk is that the move becomes discontinuous. Liquidity thins, price jumps levels. If gold starts pressing toward the $4,500 area, and especially if it threatens the prior record zone around the mid-$4,500s, you should assume the market is in forced decision mode, not price discovery mode. And if that happens, the next logical magnet becomes the round number everyone talks about, but few are positioned for, $5,000, not as a promise, as a psychological and positioning attractor. Now, here's what would weaken or invalidate the bullish near-term setup, and I'm saying this because credibility matters more than hype. If gold loses the $4,300 region cleanly and stays below it, and if it then fails to reclaim it on a retest, that tells you the market is not absorbing supply quickly enough. In that case, the next obvious zone becomes the low $4,200 and potentially the $4,000 to $4,050 region, where buyers may show up again. A move into those zones wouldn't automatically mean bull market over, but it would mean the market needs a deeper reset. And deeper resets are where people get emotionally broken. That's why you need the plan before the candle. Also watch the macro inputs that can flip the narrative quickly. If real rates surge, or if the dollar catches a strong bid on policy repricing, gold can get hit. If geopolitical tensions meaningfully de-escalate, some of the urgency bid can cool, and if those record flow signals in ETFs slow dramatically or reverse, that would matter. Flows are a force until they aren't. The market won't send you a polite memo when the force changes. So what are the concrete, what to watch next? Signals that don't require you to be a professional trader? Watch the behavior around the obvious levels. $40, $300 as the line that separates controlled maths from Hinari's unstable. The mid-4400s as the reclaim zone that signals strength, and the mid-4500s as the pressure ceiling where squeezes either ignite or fail. Watch the speed of drops. If down moves are fast and recoveries are slow, that's distribution. If down moves are sharp but recoveries are immediate, that's liquidation being absorbed. The difference is everything. Watch the curve psychology even if you don't trade futures. Gold typically carries in contango because of storage and financing. If you ever see signs of stress where near-term pricing acts unusually tight relative to later months, that can signal physical urgency. You don't need to memorize basis formulas. You just need to understand the principle. When the front of the curve tightens, it often means someone wants metal now, not later. And when someone wants metal now, paper promises get tested. Watch inventory optics with a skeptical eye. Total stocks don't always tell you what's deliverable. There is not the same as available. In tight moments, deliverable categories, and the willingness to part with metal matter more than aggregate tonnage. If you hear commentary about plenty of gold, ask plenty where, under what terms, and for whom, because physical markets are not a charity, they are a negotiation. Watch the narrative timing. This is subtle but powerful. The scariest headlines often hit after the first leg down, right when weak hands are most emotional. That's when experts suddenly become urgent about locking in profits. The market loves to make you sell after the damage has been done, right before the recovery begins. And that's not conspiracy, that's crowd psychology meeting incentives. The next detail is what flips the whole setup. Who gets punished by volatility? Volatility punishes the person who needs certainty. It rewards the person who can hold a structured view. Banks and dealers don't fear volatility because it's spooky. They fear it because it consumes balance sheet and triggers client blowups that create operational risk. When volatility spikes, margin requirements can rise, credit terms can tighten, positions that looked safe become unstable. That's why the industry suddenly sounds paternal. Protect your gains, reduce exposure. It's framed as care. Sometimes it is, but it also conveniently reduces the probability that clients implode and create losses that land back on the intermediaries. Now let's connect the physical rebalance fingerprint to this behavioral layer. If gold flows distorted trade data by nearly $19 billion month to month, that suggests real rerouting of metal. Real rerouting implies real hedging adjustments. Those adjustments create moments where the market is less about fundamental value and more about alignment. When alignment breaks, you get violent price action. And violent price action is the perfect environment to induce liquidation. That's why you hear liquidate language when the market is still structurally strong. They want the froth out. They want less leverage. They want fewer fragile participants. Because fragile participants turn normal dips into disorder. And here is the uncomfortable truth for viewers. You are the most valuable product in this ecosystem when you are emotional. Your panic is someone else's liquidity. Your impatience is someone else's entry. Your need to be right now is someone else's ability to buy low-risk exposure slowly. The shield is to stop thinking in single outcomes. Use the two-scenario lens. Respect your invalidation. And decide ahead of time what you are and are not willing to tolerate. So what comes next over the next 1 to 2 weeks, specifically? Expect attempts to shake confidence. Expect sharp drops that feel personal. Expect reversals that happen fast. Expect a fight around $40,300 because that's where psychology and structure collide. If the market can't break and hold below that line, the message is that selling is being absorbed. If it breaks below and can't reclaim, the message is that the reset is deeper and you need to stop treating every dip as the dip. Expect the market to test the mid-4,400 zone as a strength checkpoint. Sustained trade above it suggests the market is rebuilding momentum. Failure there, repeated, suggests distribution, or at least time needed. If momentum returns, and we see pressure toward the mid-4,500s again, you and Matsumoto are back in the zone where squeezes can ignite because the market remembers the pain of being underexposed. That ES when targets like $5,000 stop being clickbait and start being a realistic risk case that institutions have to consider in their stress tests. Not because it's guaranteed, because it's possible. And in risk management, possible is enough to force behavior. And don't ignore the calendar. As we move through January, you get the first real read on whether year start allocations are sticking, whether funds are still buying, and whether the physical system remains active. Watch the next trade report and macro prints because they can keep surfacing distortions from metal movement. When gold shows up in macro data, it's telling you the system is active underneath the chart. That's a different environment than a quiet, purely speculative move. Now, I'm going to give you one more layer that most mainstream coverage won't de-emphasize because it sounds too inside baseball, but it matters. In a hot gold market, the difference between paper and physical isn't philosophical, it's functional. Paper exposure is cheap, fast, and liquid. Physical exposure is real, slower, and constrained by logistics and financing. When stress rises, more players care about the functional reality. They care where the metal is. They care what collateral counts. They care about settlement pathways. That yes, why the physical layer can veto the paper layer at the worst possible moment for complacent shorts. It doesn't happen every day, but when it does, it's sudden. And that's where the real pressure starts. Let's also address the skeptic's favorite line. If banks are bullish, why would they tell clients to cut? Because a bank AS forecast is not the same thing as a bank as its risk appetite. You can believe gold is headed higher over months and still want your clients less leverage today. You can publish a big target and still expect a violent pullback first. In fact, that's usually the honest view. Wide range, high volatility, bigger trend intact. Some recent bank commentary has explicitly framed 2026 as volatile with a wide trading range, even while projecting upside potential. That's not contradiction, that's reality. So if you're listening to this and thinking, okay, what do I do with this? The answer is, stop trying to win the whole movie in one scene. Decide whether you're an allocator or a trader. If you're an allocator, your job is to avoid getting shaken out by noise into size exposure so you can survive volatility. If you're a trader, your job is to respect invalidation and not confuse a thesis with a position. The same thesis can have 10 different trades inside it, and most people lose because they treat one entry as destiny. Here's the subtle CTA, and it matters, because this isn't just information, it's behavior. If you're the kind of person who wants mechanisms, not slogans, you're already in the minority. Stay with that identity. Don't let volatility turn you into the person the market is designed to harvest. In this community, we don't worship price. We study what price forces participants to do. We track the plumbing. We watch the calendar. We let the noisy crowd fight about headlines while we watch the signals that actually move risk. Gold can absolutely rip higher from here. Gold can also punish impatience first. Both can be true. The hidden detail is that a nearly $19 billion swing in a national trade number helped reveal how active the physical and routing layer has become. The conflict is that institutions want a calmer tape while the underlying forces are still pushing. The payoff is that you now have a framework, 2 scenarios, key levels, confirmation signals, and an invalidation line that keeps you honest. And if you hold onto that framework when the next violent candle hits, you'll be ahead of the crowd that only learns after it's too late. Because the market's favorite trick isn't taking your money. It's taking your conviction right before the move you were waiting for. And if you don't have a shield, the market will build one for you, out of your own fear.